Good afternoon and welcome to the 2 p.m. session of the Distressed Credit Trading and Asset Performance Update presented to you by the Fixed Income Investor Network. This is the afternoon panel on commercial ABS, the time to be an issuer. I'm just going to give it another minute or so to let some additional participants join us, and we will get started shortly. Okay, so just to keep on time, we're going to go ahead and get started. It's my pleasure to introduce Brian here. Brian is a board member with the Fixed Income Investor Network and chair of the Private ABS and Commercial ABS Task Force for FIIN. So Brian, over to you to kick off the panel.
Thank you so much, and appreciate everybody logging on this afternoon, and hopefully you've all found the rest of the conference helpful and informative. I think one of the things we try to do on the Fixed Income Investor Network is update everybody about the relevant issues that are here in the market. And our task force is really focused on parts of the private debt and the commercial ABS space. A little bit of a catch-all, but we have some great topics to go through today. We have a number of members on our task force, two of which we're fortunate to have with us today. I'd like to probably allow them to introduce themselves since they'll do a far better job at it than I would. Caroline, if you don't mind.
Sure, thanks, Brian. Caroline Chen, I work at Income Research Management. Income Research is a 90 billion AUM fixed income money manager based in Boston. I work at the investment research team, and I cover asset-backed securities and an agency RMBS.
And Scott?
Yep. Thanks, Brian. My name is Scott Hofer. I work with Loomis Sales, also a money manager based in Boston. And I cover commercial asset-backed securities, including rental car, equipment, aircraft, timeshare, you name it.
That's great. Well, again, thank both of you for being here. Again, my name is Brian Herr. I work at Exos Financial. Exos was founded about 3 years ago by Brady Dugan, the former CEO of Credit Suisse. We focus on a number of different areas within the specialty finance and asset finance areas. A few of these areas we're going to talk about today, I don't have any experience in. So I'm going to be the moderator and leave all the important, more thoughtful statements to my colleagues here. The first area we wanted to talk about, though, is the travel industry, and this is going to include both aircraft and rail car. I think, speaking for myself, I haven't been on a plane or out of the tri-state area in over a year. So I think these are two extremely timely topics. Maybe we can start at a high level. And Scott, if you wouldn't mind, maybe just a state of the markets on the aircraft space. What have some of the trends been? Overall collateral performance, some trading metrics would be really helpful.
Yeah, absolutely. So as of last month, base rent collections were still pretty depressed in the aircraft ABS leasing sector. They're currently tracking at around 60% of pre-COVID levels and have actually declined from 70% late last year. Asset sales have slowed down considerably. Some of the even the senior bonds have fallen pretty far behind their target principal schedules. So we've had a huge decrease in revenue over the last year as COVID hit. As far as trading goes, we've seen a huge rally took place late last year and early this year. The senior bonds, the Class A's, are now trading in the very high 90s and some above par. That sort of equates to a 3.5 to 4.5% yield to the ARD. Class B's are mostly in the 90s, anywhere from low 90s to high 90s, sort of 6 to 10% yield to the ARD. And Class C's, much more fewer trades taking place in that tranche, but that's anywhere from the 70s, and I think there's been a print even in the high 80s. So there's obviously been a huge rally in these asset class in these bonds over the last year, despite collections declining considerably.
That's great. And then I guess, just a, I guess specific to that point, just stay on aircraft for a moment. Given the amount of liquidity in the system, recovery in those price levels, there seems to indicate that there's substantial recovery in air travel. Is it something that you feel is overdone? Sort of what's the argument for aircraft market values and subsequently lease rates to recover?
Yeah, I mean, I think you really have to look at it at a deal by deal basis. There's some deals that have where collections have recovered quite well, and even the subs are back on their target principal schedules. Meanwhile, other deals haven't paid any principal in over a year now. So it really kind of matters deal by deal. I would say in aggregate, ABS still seems cheap to corporates. To get 4% type yields, you kind of have to venture into second lien, third lien EETCs, which obviously have structural leverage and much larger downsides. So I would say you kind of have to look at it on a deal by deal basis, but in aggregate, they certainly feel cheap to corporates. That's
great.
I will add, you should really look at this from a short-term and the long-term perspective. Long-term, we know this situation not going to last forever. Travel going to be back. We all going to be back to office, so business travel will pick up. In the short-term perspective, I think it's still going to be a bumpy road to recover. If you just look at the January traffic data released by International Air Transportation Association, I think RPK was down by 6.6% month over month. And if you compare this level versus pre-COVID-19, January 2019, it was down about 72%. And this is also the first month's decline since April 2020. So that just highlights, the recovery road not going to be very smooth. We having this virus variants ongoing, and it's about the pace of vaccine administration. And also depending on each individual government, how their regulation gonna be. For example, like say China accounts for about 20% global RPK, and the Chinese government recently say if you're gonna go there, for travel or business, you have to. They only acknowledge the Chinese manufactured vaccine. So how many of us willing to take, a foreign country vaccine versus our own American vaccine? This is, a different question. So I think for short term, we're still going to see some volatilities going on.
Yeah, that's a really interesting point. And I guess that does dovetail a little bit into, the other segment of the sort of travel industry we want to talk about, and that's on the rail car space. Again, just Caroline, it'd be great if you wouldn't mind just kind of giving a high level on collateral performance and some maybe trading metrics that you've witnessed.
Sure. So I think a rail car ABS in general past year, the performance have been stable. Unlike people move, the flow of goods, commodities, these are still maintained during pandemic. So in terms of the utilization, pre-COVID-19, I would say rail car ABS utilization would be in the high 90s. During the pandemic, we did see utilization number a notch lower, but still they can be maintained at mid-90s. In terms of debt service coverage ratio, I think most of the deals, they are passing their trigger levels. We see rating agency maintain the BBB level for the most senior rail. We haven't seen so many or too many foreign angels from the rail car ABS. One particular weak spot, I would say, may related to frac sand industry, because the energy price was very weak last year. So end up we didn't see too much fracking activities. So there's a less demand for the frac sand, as a commodity. So for rail car ABS, you have exposure to frac sand as a commodity. I would say, the performance tended to be a bit weaker than the peer ABS deals.
Oh, that's really interesting. And I guess, I know the Fixed Income Investor Network is pretty focused on this as well, and we have a task force around this. But um, ESG investing has clearly been top of mind. It's you can't pick up a newspaper without reading about it. What are there any considerations within the railcar space around ESG investing?
Sure. So this is a good question, Brian. I think ESG has become a major theme in these days investment. So we actually think railcar ABS could be a good, asset class to recommend to our ESG portfolio. Especially in January, Trinity, it's a publicly listed company. It's also most programmatic railcar ABS issuer. They announced that their green financing framework, which is going to including both railcar ABS and their corporate debt into the green category, which is supported by Sustain Analytics. It's a Morningstar company. So in general, I think railroad operation, we can, based on the statistics we see, they are considered 3 or 4 times more fuel efficient than the truck transportation. That way, lower the greenhouse gas emission. And also the railcar lessor in general, they are heavily regulated by different federal and state government agencies. So in general, we think this is a good asset class to recommend in the ESG investment toolkit.
Oh, that's great. And then, just bouncing back a little bit to aircraft, Scott, obviously you referenced trading levels, are elevated again, not near, in some cases, not back to pre-COVID levels, but, new issue space, new issue deals are getting done. And have you seen any significant structural changes? Do you think, and if so, do you think those changes are enough necessarily to sort of compensate for where pricing is coming out?
Yeah, I don't know if I'd call them significant changes. There's definitely been some tweaks to the deals, such as having customized advance rates for different aircraft, customized amortization schedules, kind of tried to make the performance triggers a little bit more reactive by, for example, making the DSCR ratio a 3-month look back instead of a 6-month look back. But overall, it's still the last deal that came to market in January is still a pro rata pay structure that is, I think, still vulnerable to large swings in LTV, right? I would have preferred to have had a full turbo or sequential structure where you're really rapidly building enhancement from day one. But maybe we'll see that in future deals. I also, would love to see, some kind of, market value trigger, LTV trigger that would redirect principal when you have a huge shift in the market value of the collateral. And, I think that that vulnerability to having large swings in loan to value is really the biggest weakness of those deals.
That's interesting. And then, maybe just a sort of follow-up question on just to stay with aircraft here. I think it was Carlisle who's, potentially purchasing fly leasing, kind of given the excess capacity in the industry, do you think we'll see more transactions like that or consolidations within the aircraft space?
Yeah, absolutely. We had the GCAS AirCap acquisition a couple of weeks ago, and now fly leasing in Carlisle. Even just looking across the ABS space, you have many lessors that manage less than 100 aircraft and have really been disadvantaged in the debt markets since COVID hit. So I would absolutely expect further consolidation to take place. That's
great. And then Caroline, in terms of the railcar space, have you noticed? I mean, new issue. Have you noticed anything, post COVID, despite it holding in, really well? Have you noticed any structural changes within the new issue space?
Sure. So in general, because I'm seeing there's so many capital chasing yield, these days in general structure are very issuer friendly. In real car space, I think post 2018, there's no limits in terms of issuer can dispose the underlying rail cars. This certainly adds the operational flexibility to the servicer, but it's at the cost of the investor as well. And in addition, I think if you dispose rail card up to a certain percentage, there will be no make-whole premium to investors. So in this case, I think investors be aware there's some prepayments, but you don't really get any prepayment penalties. And the other thing I want to mention is, unlike aircraft lease, rail car, majority of the lease, they are like a full service structured. About the 75% tank cars in US, they are owned by lessor. This require high maintenance. So if your maintenance cost is higher than projected, that will certainly drag down your debt service coverage ratio as well.
Oh, that's great. Yeah, it's really helpful. I think obviously we have we have somewhat limited time, and I know we wanted to just touch on another potential asset class in the whole business area. I think that's obviously again, very timely, been an area that's been, may not necessarily fit the parameters of distressed credit trading today, but there's not a heck of a lot of distress around, it feels like, but certainly an area of the market that's seen substantial impact, due to the pandemic. So maybe as a first question, and it could be a bit of a jump ball, who, Caroline or Scott, whoever wants to take this first one, but can we just get sort of an update on, surveillance and trading trends within the whole business space?
Yeah, sure. So, initially in March and April of last year, you had a really steep decline in securitization revenue for most WBS concepts, but for the most part, they proved to be pretty resilient. You had in the quick service restaurant space, sales recover quite rapidly, particularly for names that have strong delivery and drive-through platforms. Some even had double-digit same-store sales growth last year. So they've proven to be most concepts have proven to be quite resilient through COVID, and really only a handful of bonds are trading at a discount at this point.
Yeah, I agree with Scott. I think in this sector, performance definitely bifurcated. You could have sponsor their business model very recession resilient. Say ServPro, Service Master, they even see demand for cleaning service because of the COVID-19. Then you're also seeing quick service restaurants, they have option for delivery, takeout, or third-party delivery. Then you see these kind of QSR restaurants, the COVID-19 impact is not as severe or same level as those casual dining because of the shelter in place or stay orders. So I would say it's very bifurcated performance trends we're seeing there. One thing I want to highlight is, Wendy's, if anyone noticed, because of public announcement, they have one of their largest franchisee actually filed a bankruptcy during second quarter of last year. And I think that's just a highlight case, for investors to see, because we don't see so many bankruptcy franchisee cases in our whole business sectors. It's important that you have a diversified franchisee, network, and also you have a well-managed franchisor. So even in this case, you have a large exposure to a particular franchisee, you may not end up too much cash flow disruption to your ABS bond.
Yeah, that's a really interesting point. I guess this is certainly one of those asset classes that cuts across, structured credit and corporate credit markets. A lot of ABS does, but certainly in the whole business space, this is something that there's a lot of overlap. Do you think investors should consider it, consider an ABS or a corporate exposure in some cases, or is it sort of issuer dependent?
Yeah, I think you kind of have to look at it as a corporate exposure. I think it's difficult to separate the performance of the manager from the performance of the brand, particularly when you know some of these names have a high amount of company-owned restaurants in the deals, and you know we've seen you know some issuers even use WBS as a way of you know, acquiring other brands, which clearly has some element of corporate risk involved there. So I think you have to think of it as a corporate exposure, but nonetheless a senior corporate exposure. You know, there are some whole business sponsors that issue both WBS debt and non-WBS debt. You know, the WBS are clearly senior to that non-WBS debt and have priority over the franchise cash flows. So you know, certainly a corporate exposure, but a senior corporate exposure.
Yeah, I agree. I think it's, you know, yes, no question. Because, you know, yes, it's structured as ABS. Without the ABS structure benefits, all these bonds not going to be qualified for IG rating. It's no, because I think from relative value, you know, comparison purpose, I'm not going to compare a whole business ABS BBB versus, like, say, a subprime auto BBB. It's more makes sense you compare with BBB corporates versus also like a BB corporates. So we look at the relative value perspective. We certainly compare, you know, whole business ABS versus our corporate counterparts in terms of the valuations. And I think the other thing about the whole business ABS that's unique is, you know, you need to look at the quality of the EBITDA. When you buy timeshare, when you buy, you know, subprime auto ABS, you don't care about the sponsors, you know, the P&L, how their quality of EBITDA is going to look like. But when you look into whole business ABS, the quality of EBITDA matters, because that tells you the leverage ratios and how quickly, you know, the company can delever and issue the new debt to refi, you know, repay your older debt when they reach the ARD.
Yeah, it's great. I mean, obviously, you know, over the past year, it's hard to find an asset class that hasn't been tested from a performance standpoint. And I think structurally, you know, as you both point out, you know, the whole business securitization does, you know, there's a corporate element and there's a structured element to it. Do you think whole business is generally held up as originally contemplated under the market stress that we've seen?
Not quite. I think, you know, some interesting things happened, you know, in the second quarter of last year, right after COVID hit, where we had this huge, really liquidity crisis for many of these companies. And, you know, obviously there's an interest reserve in the deal that's supposed to, you know, help out with liquidity issues when those arise. And, you know, what we saw was managers, you know, waive the management fee to try to, you know, solve this liquidity issue. And certainly wasn't an outcome that, as an investor, I would have expected had someone told me that we'd have this huge decline in revenue.
Yeah, I totally agree with Scott. I think that the waiver management fee is definitely investors should be pay attention to, because the DSCR trigger in whole business ABS are very generous to start with. It's just my opinion, because, you know, your whole business ABS, your bond structure as, you know, more like a soft bullet. You amortize 1% a year. Majority of your credit exposure gonna be paid off at the ARD. So you really, it's not like amortization bond, the same type of quality of debt service coverage ratios. That's also why, you know, even the franchisee, they experienced financial difficulties during COVID-19. You don't really see our DSCR get impacted too much, right? And on top of that, you waiver the management fee. And the management fee is also a very hefty numbers. They can cap at 35%. You look at the aircraft or rail car ABS, the typical servicing fee is, I would say, 5%, 6%. You barely see in ABS world a management fee can reach to 35%. And then not to mention, if you look at details of prospectus, the structure of the management fee, they are also very different. They started with a base number. then they can add additional, either based on the number of new stores they open or the additional sales they generate, or the additional retained collections from the securitization cash flow. So they are all very different. And the management fee gonna escalate on annual basis on 2%. So this is also something I only see it in whole business ABS. So assuming your franchisor, your franchisee manager this network, they don't even generate any new sales dollars, your management fee gonna still bump up 2% a year. That's gonna be leakage to your cash flows.
Right, and I also think it's important to note that the note holders were pretty much left out of the entire process when this waiver, when these waivers were taking place, and there really wasn't in some of even the new deals, they haven't really put a limitation on the total amount they can waive or the duration of these waivers. So it's certainly something that investors should be aware of when analyzing the credit risk in these deals. Thus far the rating agencies really haven't said much on the topic, but we think it's certainly something worth noting.
Yeah, that's really helpful. I didn't know much about that issue at all until you both started talking about it as we were preparing for this. So, definitely really interesting. I guess similar to the aircraft industry, where I think we touched on some consolidation and larger scale. Lessors having just not having the wherewithal. Going forward in some cases and being disadvantaged. Do you think there'll be consolidations in the whole business area? And what do you think the potential knock-on effects of that could be?
Yeah, I think the restaurant sector, like aircraft leasing, still very fragmented, right? And I know, Rourke is raising even more capital, so I could imagine more acquisitions taking place, this year and into next year as well. That said, I think with the purchase multiples being so high in the restaurant sector, if you just look at where Dunkin' was purchased, a lot of these private equity sponsors are certainly going to have to put write a fairly large equity check if they are going to be buying brands at this point in time. So that might ultimately limit the amount of deals that take place, but certainly expect more consolidation over the next couple of years.
Yeah, I would just add, even for those PE firms, they may continue to acquire the new brands, but not necessarily mean all the brands going to be suitable for securitization as a sponsor, because for whole business ABS, we'd like to see highly franchised models with stable cash flow, long-term franchisee agreement, have some track record to manage that brand. If you recall in the past, we do have some names came to this space, but the deal didn't fly, right? I mean, basically investor gave a cold shoulder because it's not a highly franchisee business model. So you look at your securitization revenue source, only I would say maybe 1/3, gonna come from the franchisee and the royalty income. You have another 1/3 come from the corporate profits, P&L, which is not, I think, is something suitable for securitization, because you don't want to be exposed to that corporate part. You want the stable franchisee fees and the royalty income to be present in your securitization trust.
Yeah. I guess within it's great. So within the whole business area, are there how do you both sort of feel about the risk reward right now? I guess kind of given where pricing levels are and where we are in terms of the market cycle and spreads and everything like that. And it again, no name specifics, but certainly just holistically, I guess.
I think they're very expensive now. You need to run everything to call instead of to maturity, right? Because these bonds all traded like a high dollar premium right now. granted they have good carry. If you look at the coupon, they're still, very attractive. But I would say, because we always compare the spread level between, our tier 1 or tier 2 whole business names versus the corporate triple B, 1 to 5 year or longer term 5 to 10 year, or even like a double B index. I think they are trending, the spread difference, they're trending towards the average level we've been seeing. So it's getting harder to find good relative value opportunities. Not to mention, like the structure side, it's just become more and more issuer friendly. I think these days, people just talking about give lots of thoughts on the valuation, but tend to ignore on the structure side, because when things happens, you will notice the structure make a huge difference. A good structured deal can protect investors. If you look at some very loose structured deals, then you may subject to unexpected loss, I would say.
Yeah, I would agree with Caroline that the levels are getting a little tight. I think we had the lowest coupon ever on a recent whole business, a 7-year whole business tranche just issued a couple weeks ago. So yeah, it's in ABS you can't really find many places for yield. The whole business is still one of them, but it's certainly getting tight.
Yeah, and not to mention that new deal has type of like a pre-funding mechanism, which we don't typically see in the whole business sector. We can see this in like timeshare, private student loans, ABS in the past, but it's just whole business ABS. It's operational assets. This is not something usual, I would say.
That's really helpful. I know we have a little bit more time, and I don't want obviously don't want to put anybody on the spot, but we'd love to get both of your thoughts in terms of maybe we're only through the first quarter of 2021, and areas are just starting to open up, and it's still very early stages, but where do you see some opportunities in the market? Maybe we can stick to what private and commercial ABS, but just generally speaking, where do you guys see opportunities for the rest of the year? I don't know if Caroline,
I think consumer ABS, the MADs or subordinate bond could still have some values, because consumer just work out of the crisis. You understand the consumer balance sheet still remain very strong. Our housing market is very stable, so we actually like the consumer ABS, and we also looking at some opportunities in the RMBS side. Not necessarily mean we don't buy whole bids or commercial ABS. I think we still have good relative value opportunities there, especially bet on the recovery. I think aircraft ABS, rail car, they're still very good options. But on the same time, because we're traditional money manager, we need to manage the liquidity as well. If something happens, like last year onset of the pandemic, then you want to make sure the liquidity is still there to support you.
Yeah, we talked a little bit about aircraft at the beginning. Still, the seniors I think still have good relative value to WTCs. Obviously have to be very careful deal by deal, but that's one sector that I think still has a little value. Outside of that, I think you really kind of have to venture further down the capital stack, whether that be in equipment subs, timeshare subs, rental car subs, to start picking up some spread, because I still think there's still some opportunity for spread tightening in recovering sectors further down the capital stack.
That's great. Well, we have about 5 minutes left, I think, and I don't know if there's any questions out there that are opened up, or anybody's got some questions. I know we have a Q&A open. If anybody would like to ask some questions of our friends here. otherwise, I think we covered everything we wanted to cover today. Hopefully it was informative. Oh, we got a question coming in. Sorry, I was about to do the wrap up. Do you expect to see infrastructure financing come into your space?
Yeah, I mean, we've kind of already seen that take place. I guess, depending on how you classify infrastructure, we've had, obviously like the data center deals. We've had the Fortress triple net lease deals as well with Amazon. So kind of already seeing, deals in that sector take place. But I don't know if Carolina has any thoughts.
I think they just follow up is within the new government plan. I haven't seen like a public deals like this. I think it would be interesting if we're going to see this, as a new asset class. But again, I think, the typical hurdle for me as a traditional money manager is if you have a new asset classes, usually the rating agency not going to have a rating methodology ready right away, then I may have allocation hurdles because, some of my investment guidelines may not just, handcuff me to buy, not rated deals or not rated by the biggest three. But otherwise, I would say I will, always be open to new asset classes if there's going to be a new asset classes rising on down the road with, sufficient yield to compensate to investors. I would definitely keep an eye on that.
That's great. Yeah, that's really helpful. And appreciate the question. That was really helpful, really great. But again, I think as we sort of look at to the rest of the year, I think our task force continues to work on a number of, I think, very timely and creative issues, and we welcome, we welcome all incoming suggestions as well. I think a lot of what we try to do at the Fixed Income Investor Network is obviously, hopefully address some of the issues that are all relevant to ourselves on the buy side, relevant to the current market environment, and certainly we're, extremely open and would welcome as many suggestions as possible. So again, I appreciate Scott and Caroline's time. I think it was, certainly informative for myself and really helpful. And, thank everybody else for joining our webinar here, and hope everybody enjoys the rest of the conference.
Thank you.
Thank you.